Hello, welcome back to my channel, Value Investment with Manan Shroff. Today, I just want to emphasis on this down market. Many of you are scared. Many of you are thinking that let's take a loss and sell everything, or you are not sure about what's going to happen because your investment is down. But I just want to point it out that the current uh, market is a wonderful opportunity to purchase a wonderful companies at a discounted price. And when I mean that, I just want to show you why. I mean, if I tell you, I don't want you to believe it. If I show you the calculation numbers that make sense, then you believe it, and then you decide. So this video I have made just for guys who are very confused right now, thinking what to do with the investment. They will probably down 30, 40%, or they may be scared right now. And I just want to show you that why this is a great opportunity buying. Now, my love is for technology company at this point because they are very down. But in this video, I will also show you that market is incorrectly punishing so many companies. So without that, this is a disclaimer. And before we go to the, so right now market biggest problem is inflation. It's not worry about that the inflation will slow down the purchases. The market worries about right now that inflation will tell Fed to move the rates upward. So currently, right now, 10-year treasury is trading around 4%. Okay. And market is very panic right now. And thinking is that what's going to happen if Fed raise the interest rate by 1 more percentage by end of December or by end of next June. Okay, so in nutshell, we can say that the US 10-year treasury bill within a 1 year, if we believe the Fed because of the inflation, the US treasury 10-year should be traded around 5%. Okay. So when we look at it 5%, so most of the people says, okay, I mean, why I would invest in the stock market? You know, I'm getting 5% yield, which is okay. I will show you why. The problem with US 10-year treasury 5% is you have to consider this one as an investment perspective. So basically what you are doing is you buy treasury usually in 100 multiples. So basically what this is saying that if you buy 10-year treasury today, and I'm just saying, I'm not counting 3.88 or 4%, I'm counting 5%, 1 more percentage up than what it is currently trading, okay? That means, so US Treasury in the simple terms going to pay you $5 every year for next 10 years, correct? So because see, if it's 100, you are investing $100 in US Treasury and you are receiving 5% dividend yield. So what does this mean? This means you are receiving $5 annually on $100 of capital. So it's a kind of business, right? Every business has a price and earning. So here the price is $100 and earning is $5. So what that equates the PE ratio. So let's find it out, the PE ratio. So it's $100 is our price for treasury divided by 5, which is our earning, 20 times PE ratio. So market, I'm just saying, I'm adding one more percentage. Right now, this is 4%. I'm adding one more percentage, 5%. And I'm telling that why market is wrong, people are wrong, and people are waiting on sideline are also wrong. This is my thinking. This is one of the greatest opportunity. So look at this number. That means any company. Now here you have a problem. The problem is this: US 10-year treasury bill will not grow. There is a 0% growth. Okay, so on the year first year you will receive $5, second year you receive $5, third year you receive $5, fourth year you receive $5, fifth year you receive $5, sixth year you receive $5, 7, 8, 9, 10, $5. Okay, now I'm not looking at even technology. I'm just going for the. I just want to show you why market is wrong. We go to this Dow company. Okay, so this is a chemical company, and this is not a technology company. And I don't understand why are you punishing this company. So let me show you this. It is currently providing you 6.5% yield. Okay, that 6.5% yield is more than the 5% yield. So does it make sense to invest into the treasury yield if the Dow doesn't have any growth? And actual yield for Dow, let me show you what is actual yield. It's earning $8.70. Let's go to the 2022. Average estimate is $7. Okay, so it's earning $7. So, and its price is 44.66. Okay. What is this PE? Is 6. It is a 6 PE. Just think about it that the treasury you are paying 20 times, right? Because you are earning $5. And if you have capital $100 invested in treasury bill and $5, I'm again emphasizing that I'm putting one more percentage. Right now, the treasury yield is 4%. Okay. And this company is giving you 6.5% dividend. That's a dividend yield. But look at the earning yield. We look at the earning yield. The same way what we did with the treasury. The treasury was making $5 here, and we divided by the price. So let's see. That was a 5% dividend yield. So if we want to find it out, the dividend yield, earning yield for Dow. So what we can say that if you invest $45 right now, for within 1 year, you are able to earn $7. Okay, so basically you are investing $45, you are earning $7. Let's find it out. What percentage is that? 7 divided by 45 multiplied by 100. So treasury is paying you 5%. Dow is paying you 15%. Out of 15%, 6.5% is dividend, and another 6. More than what is this? 15.55 minus 6.5, 9% is earning yield. This is one company, right? We go to any company. I have this I have this list here for Dow 30. Okay, you pick any company from this thing, and I can bet you that the company is a lot cheaper than buying the treasury bill right now. So if you buy any good company, let's say about 3M or McDonald, McDonald. Let's look McDonald. What is the McDonald? So McDonald is on high PE. Anything about, we have to look for the PE less than 20, right? So here we go here to statistic. Okay. Okay. So market now, what is doing market here is our threshold is 20 times PE, because remember the 5-year treasury bill. Now market is paying for McDonald 29 times, and forward PE is 22 times. So let's see how much growth McDonald has. McDonald has a 7% growth. Okay, but market is paying about 30 times ratio, 30 times. Okay. So let's look now. Here, if you see, this McDonald company is going at 7% earning, and market is paying 30 times PE. Okay, and market is not worried about that, and people are very happy to put money in the McDonald. Okay. I will go to the Google. Now, here is completely different story, okay? Let's say Google is, next 5-year growth is 9%, which is close to McDonald, 7%, little bit more than McDonald, right? Okay. How many times earning you bring? Market is paying 18 times. Why you are paying 18 times? You are paying 30 times to McDonald, which is growing at 7%, and the Google, which is growing at 9%, you are paying only 18 times. Why this discrepancy? So you can pull any company. There is a market disorientation. There are people who think that dividend stocks are very good right now, and they are pouring all the money into the dividend stocks, which is fine. But I'm saying that you have to compare with the other investment. Investment is always about the comparing with what other opportunity you have. Okay, so in this way, I don't understand the market. The market is, do you think the McDonald earning is more stable than Google earning? I don't think so. Both companies are doing good. Especially Google is going to do well with the advertisement for next year, 10, 15 years. If we can look at the Coca-Cola, okay, this is another company. Market is paying, let's say, what is their growth? Their growth is 5.36%. Okay, they are growing at 5%. Remember, treasury yield, the one I said that 5% yield, it's not growing at all. So that is a worst investment, because here you have a growth 5.36%. Then treasury, you are paying 20 times, right? Because $5 investment, $100 capital, the PE is 20. Okay, for Coca-Cola, let's say market is paying PE 25 times. Okay. Okay, so again, here is the disconnection. So Coca-Cola, which is growing only 5%, and market is happy to pay 25 times PE, but because the Google growth is not there anymore, or Google growth is less, market is paying only 18 times. So there is completely disconnect between price. So the first thing, if you invest in treasury, it doesn't make that much sense right now, because there are companies, I mean, I would buy rather Coca-Cola. Just think about it. The Coca-Cola is paying almost close to 3.24% dividend yield, which is close to our treasury yield. Plus, it is growing at 5.5%, where treasury yield is not growing. So if you compare with the treasury to Coca-Cola, Coca-Cola is superior investment than treasury. If you compare Coca-Cola with Google, Google is superior in investment. The reason why Google is superior also, I can show you that Google might not have any debt. So Coca-Cola is a 42 billion debt and cash is 11 billion. If you look for the Google, it has a debt, but just think about, just look at here, 125 billion cash, 28 billion debt. Company is only putting $19 and earning how much? $5.12, which is the return on equity. Return on equity is 26%. So now let's pick another example here. And so I'm saying, what I'm trying to prove, that this is the very, very, you want to be in the market this time. I mean, treasury bill, going into the treasury bill doesn't make the sense. Let's go to the Johnson and Johnson. So Johnson and Johnson, we compare it with the treasury, okay? So Johnson and Johnson is a good company. They have the good cash and everything. Let's see how much Johnson and Johnson is making, okay? So Johnson and Johnson is making $6.87, okay? So if we want to find it out earning yield, we're going to divide this with the price and multiply by 100. So we can get earning yield. So earning yield is 6.87 divided by 164 times 100. So earning is 4%. So right now, if you buy treasury, you get 5%. You buy Johnson and Johnson, you get only 4%. Okay. Now we have to look for the growth also. Okay. Growth is 4%. So here, I don't know, you might be treasury is winning here. The reason why, so, but people are paying for Johnson Johnson because they think it's a dividend income company. And so what I'm trying to say through this video, that please compare the investment return rather than just blindly go after the what other publics is doing. So right now the market is pulling all the money and then putting on the safe stock like Johnson Johnson, Coca-Cola, which is good, but it's inflating. The price are inflating, and the price are inflating and doesn't make sense when you compare with treasury bill or when you compare with other technology companies. So in the technology company, if you go, let's say Qualcomm, and we compare Qualcomm with Johnson Johnson, let's say. So Johnson Johnson is making on $164, it is making $10, right? Okay. Let's make a note here. So Johnson Johnson current price is $164. It's growing. What is the growth? 4%. Okay. Growing 4% and making $10. Earning per share is, I think I can make it a lot easier. Let's just do the table here. Okay, so this is what we're going to do is here, company name, price, earning, growth. Okay, and then I'm going to do center piece. Okay, so T-bill, right? T-bill price is $100, earning is $5. Oh, right now is 3.88, but I'm putting 1% more. Okay, $5. Growth 0%. Okay, Johnson Johnson earning price is $164. It's earning $10. Growth is 4%. Let's see, Google price $98, earns about $5, I think. $5.12, growing 9%. You can make table like this. It's so easy to make table, and then just compare the investment. I mean, let's do one more. Coca-Cola. Current price is $55. Earning is what is it? $2.46, and growth, I believe, 5.36%. Okay. Qualcomm. Let's see Qualcomm. So earning is Qualcomm $12.54, $110 growth. Let's see what is the growth. Analysis growth. 7.62%. Okay. So you can compare this way, that which companies are good to invest. If you like, let's put Dow here. $44, $44. Earning is $7, and growth is minus because it shows the minus. So does it make sense right now to pour all the money into the very well safe haven Johnson and Johnson and Coca-Cola? So if you have a two choice, T-bill and Coca-Cola, or T-bill and Johnson Johnson, I would definitely go for Johnson Johnson Coca-Cola. They are growing 5.36%, 4%. I know, almost paying same amount of. I mean, earning is good, but then if you compare it with Google, with Johnson and Johnson, So sorry about that. So if you think about this here, what I'm trying to say that rather than scaring the market and rather than blindly following other people, do your own math. Okay. Um, and what I'm trying to convince you guys with this, that there are the companies that are available cheap compared to the T-bill. There are companies available cheaper compared to Coca-Cola. So like if you ask me to purchase Coca-Cola or American Express, then I can go to the American Express, right? I will go to the American Express. Okay. We add one more row here. EXP, right? And this is not a technical. So it is $139 right now. Paying it's going to make $9.93, and it is growing at 14%. If I'm not wrong, 14%. It's growing 14%. So think about this just with the American Express. Okay, you are investing $139 and you are getting $9.93, okay, with growth of 14%, right? And we bring the treasury to the same amount, the $139 to compare it. Okay, so if you invest in American Express, you entitled for $9.93, 14% growth. If you invest equivalent amount in the treasury bill, you will receive, so 100 times $5. So 139 multiplied by 5 divided by 100. So you will receive $6.95 for equivalent amount to invest in treasury bill, T-bill. Okay, this is American Express. What is the growth? 0%. Which one is more valuable? Treasury bill or American Express? American Express is more valuable. You know that American Express is going on 14%, even though if it doesn't on 14 or it's just on 10%. First of all, you are getting more better yield here by equivalent amount. And this is, remember again, the T-bill, I'm putting 5%, which 1% has not been raised yet. Right now, yield is 4%. What I'm trying to, so I'm saying, rather than blindly investing in other companies because they are safe dividend companies, yeah, the investment always going to be compared with another investment. So if you ask me between Dow and American Express, we can check like, okay, so Dow is making, so Dow is $44 in making 7%, $7. Okay. So 7 into 139 divided by 44. Just think about that. The equivalent amount of money, if you invest in Dow, you will earn $22. The growth is definitely minus 5% because of the inflation. Probably the chemical prices is going up. But just think about the change. Think, look here, how much you can earn. And based on that, you make the decision. Currently, my portfolio is entirely into the companies like Google in technology company. But I just want to bring this attention to look the stock market this way, rather than get panic of it. There are very good companies that are, I mean, look at American Express. If I have money, I would buy plenty of American Express, right? Look at Qualcomm, look at Google, you know. because these companies is that they are growing more. And so if you compare with American Express and Google, probably American Express is better investment at this point if they're going to grow 14%, and their PE is also low. So the investment is always going to be compared with other investment. But I just want to say that because market is going down, you want to sell and take a loss, don't do that. I am all in. I have invested in my last spending, whatever I can afford in the market. This is a very good market. So rather than getting scared and pulling out the money from the market and waiting what the other people are going to do, like a big institution, they are sitting on the sideways. Don't worry about them. Make your own decision and invest. If you have any question, you can always ask me on WhatsApp that which company is good to invest right now. But I just want to bring this attention to you that the fear of inflation is not the big cause for the market to drop. The big cause is that because of the inflation, Treasury T-bill or Fed going to raise the interest rate. And because of that, these all growth companies that have been paying high multiples are going to go down. But you can look at here. I mean, Google is making more money than Treasury bill. And if you look on the Treasury side, I mean, Google is making about equivalent money, but then it is growing at 9%. So would you buy T-bill or Google? Just because the Google fluctuates so much between $98 and tomorrow probably it fall down to $80. That is good thing, because now you are $80, the $5.12 earning is still there, and it's growing at 9%. So why you worry about when price go down? And look as a business perspective, and you can make it out good amount of money. I'm telling you, I've been doing this since 2009. I have in this situation so many times. Every single time I was able to multiply my money quickly than if market would not have this kind of volatility. So with that, if you haven't subscribed to my channel, please subscribe. I just want to point out a few things, and rather than scaring, just do your own math. It's not that hard. Invest on those companies. I mean, I like technology companies. So I've been saying technology company, and I have portfolio concentrated in technology companies. So I may not be able to find American Express kind of company and tell you, but you can do your own things, and you see that American Express is a great company. American Express is growing 14%. Then invest in American Express. I'm not just saying you invest in technology company. Invest in any company that makes sense, that makes better investment for you. So with that, goodbye and thank you.